Hello, friends. If you are drawing a Social Security check right now, or you are within a year or two of starting one, there is a tax calculation running in the background of your retirement that most people never see until the damage is done. 3 situations that happen to careful retirees all the time. Listen for yours. First, you researched your retirement state cost of living. Weather. Healthcare. Family. You knew it had an income tax and you planned for it. What nobody told you was that your state has a separate layer that taxes Social Security above a certain income threshold. You found it on your first state return, on a line you did not recognize. That was the moment the planning gap became real money. Second, you hold municipal bonds because the interest is federal income tax-free. That is true. But the Internal Revenue Service adds every dollar of that interest back into the Social Security tax formula. If you have not included it, your taxable Social Security is higher than you think silently. For every year you have held those bonds. Third, you have a pension alongside your Social Security. You estimated you were below the taxable threshold, but pension income raises the combined income formula dollar for dollar. Many retirees find their combined income has been above the federal threshold for years without their knowing. If any of those 3 sounds like you, or if you have never run the formula at all, you are in exactly the right place. 2 things I want you to stay for. By the end of our countdown, you will know the exact formula the Internal Revenue Service uses and whether your own income puts you above or below the line. And for those of you with a pension alongside Social Security, number 4 is built specifically for you. Stay for it. Quick context. This video is made for United States retirees and near retirees who want to understand how state and federal income taxes interact with their Social Security benefits. Everything I share comes from official sources, the Social Security Administration, the Internal Revenue Service, and Kiplinger, the personal finance publication that tracks state-by-state tax rules, and I will name each as we go. This is educational content only, not personalized financial or tax advice. And nothing here is a promise of any specific dollar amount. Everyone's situation is different. Speak with a licensed tax professional before any major decision. Now, let us get into it. If this is the kind of information you need, hit subscribe and turn on notifications. One question before we start, drop your state name in the comments. Just the state name. I will reply right there, whether it is one of the 8. 5 items in our countdown. We start with number 5. Number 5, the federal foundation. The Internal Revenue Service can tax up to 85% of your Social Security benefits. Not all of it, up to 85%. The formula is called combined income. Here is how you calculate it. Take your adjusted gross income from line 11 of your federal return. Add any tax-exempt interest income, including municipal bond interest. Then add 50% of your total Social Security benefits for the year. That sum is your combined income. Pause this and write these thresholds down. Below $25,000 for a single filer or $32,000 for a married couple. None of your Social Security is federally taxable. Between $25,000 and $34,000 for singles or $32,000 to $44,000 for married couples. Up to 50% may be taxable. Above $34,000 for singles or $44,000 for joint filers, up to 85% of your Social Security may be taxable. According to the Social Security Administration, the average retirement benefit in 2026 is just over $24,000 per year. A single retiree with that average benefit adds $12,000 to their combined income formula. Add a $10,000 IRA withdrawal, and combined income reaches $38,000 above the 85% threshold on what most consider a modest retirement income. Those thresholds have not been adjusted for inflation since 1983 and 1993. Every year, more ordinary retirees cross them without any vote or law change. Wait until number 2. That is where I show you exactly what is pushing retirees over the line without their knowing. Number 3, the 8 states that specifically tax Social Security in 2026. Here is what almost never gets said up front. Most people in these states owe nothing, because every one of them protects moderate income retirees through income-based exemption thresholds. The 8 states are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. West Virginia completed its phase-out this year and is off the list. The roster has dropped from 13 taxing states 3 years ago to 8. When I reach your state, pause and write down its threshold. Connecticut exempt below $75,000 for singles, $100,000 for joint filers. Maximum state taxable amount is capped at 25% of your benefit. Minnesota exempt below approximately $86,000 for singles, $110,000 for joint filers. Verify annually with Minnesota's Department of Revenue. New Mexico, most generous of any taxing state, exempt below $100,000 for singles, $150,000 for joint filers. Rhode Island, full exemption at full retirement age, below approximately $107,000 for singles and $133,000 for joint filers. Vermont, full exemption below $55,000 for singles and $70,000 for joint filers. Utah, flat rate with a credit eliminating the tax for most retirees. Phasing out above $54,000 for singles and $90,000 for joint filers. Montana, a $5,500 subtraction for those 65 and older. Peer Kiplinger's State Tax Guide. Colorado flat, 4.4% rate, but 65 and older can subtract all federally taxable Social Security first. Effectively no state tax on Social Security for most seniors over 65. Drop your state name in the comments right now. Number 1, 3 tools most retirees never hear about. Form W-4V, filed with the Social Security Administration. Lets you request federal income tax withholding directly from your Social Security check at 4 rates, 7%, 10%, 12%, or 22%. Write those 4 rates down. This does not reduce the tax you owe. It spreads payments throughout the year, so there is no lump sum surprise at filing. Second, for those retiring to Colorado before 65, the deduction is more restrictive in the 55 to 64 window. Once you reach 65, the full subtraction applies. Careful income management in those years can eliminate the tax. Third, the Roth conversion window, amplified by the senior bonus deduction. Under legislation, the Internal Revenue Service refers to as the One Big Beautiful Bill Act. Taxpayers 65 and older can claim an additional $6,000 deduction for singles and $12,000 for couples through 2028. Phasing out above $75,000 in modified adjusted gross income for singles. Roth withdrawals do not count toward combined income. Converting traditional IRA dollars to Roth before required minimum distributions begin reduces future forced income and keeps more of your Social Security below the line. 3 more tax years. Now, an illustrative composite, Harold and Carol, are fictional names created to represent a typical situation and are not based on real individuals. Harold, 68, retired administrator. Carol, 66, Retired teacher. They moved from Ohio to Vermont to be near family. Harold's pension, $28,000 per year. Combined Social Security, $40,000. Vermont's full exemption threshold for joint filers is $70,000. Their adjusted gross income pension plus the federally taxable portion of their Social Security plus modest IRA withdrawals lands above that threshold. Vermont taxes a portion of their benefits on top of what the IRS already taxed. The mechanism is the pension. Every dollar of pension income raises adjusted gross income, dollar for dollar, crowding out the space below the line. Harold and Carol did not miss this because they were careless. Nobody surfaced it before they signed the purchase agreement. If you have a pension and Social Security and have never run the formula with both numbers drop, never ran it in the comments. Number 4, how state and federal taxation stack on the same check. Most states that tax Social Security use the federal adjusted gross income as their starting point, then apply their own state rate to that same amount. 2 separate tax bills on the same check. According to Kiplinger's tax analysis, a married couple above Minnesota's exemption threshold could face state tax of $1,200 to $2,000 per year on their benefits over 20 years. $24,000 to $40,000 on income, already taxed at the federal level. A couple in a no-income tax state with identical income pays zero. I am not arguing that anyone should move. Cost of living, family, and healthcare belong in that decision. What belongs there also is this specific calculation before the house is purchased, not after. Number 2, our climax, 2 hidden triggers and 3 tools. Hidden trigger, 1 municipal bond interest. It is invisible for income tax purposes, but the Internal Revenue Service adds every dollar of it back into the combined income formula. A retiree holding municipal bonds who assumes that interest does not count towards Social Security taxation is wrong in a specific and costly way. Hidden trigger, 2 pension income stacking. Pension raises adjusted gross income, dollar for dollar. For teachers, firefighters, federal workers, and police officers with a defined benefit pension. The pension can push combined income above the federal threshold even when Social Security alone would not. Now, 3 tools. First, according to the Internal Revenue Service, retirees age 70 and a half or older can direct IRA funds to a qualified charity up to $111,000 per person in 2026 without that amount counting as income. Pause and write this down. Qualified charitable distribution. Age 70 and a half. $111,000 this year per the IRS. Direct from IRA to charity. 0 income on your return. If required minimum distributions are pushing you above the threshold, this removes that income from the formula. Second, Roth IRA withdrawals do not count toward combined income. Drawing from a Roth in high-income years directly lowers your combined income for that year. Third, the qualified charitable distribution must be the first distribution you take from your IRA each calendar year to offset your required minimum distribution most efficiently. These are the answers to both loops from the opening. If your situation looks different now than when we started, drop it in the comments. Quick recap. Number 5, combined income formula. 4 thresholds frozen since 1983. Number 3, 8 states. Income-based exemptions protecting most moderate income retirees. West Virginia now off the list. Number 1, Form W4V. The Colorado age window. The Roth conversion window through 2028. Number 4, state and federal tax on the same check. The lifetime cost belongs in your location decision before it is made. Number 2, Municipal bond interest and pension income are the silent triggers. Qualified charitable distributions, Roth withdrawals, and distribution sequencing are the tools. 3 steps. 1. Pull your most recent state return and find where Social Security income appears. If it is none zero, the tools at number 2 apply to you. 2. Bring your combined income and your state's threshold to a licensed tax professional and ask specifically about qualified charitable distributions, Roth conversions, and IRA distribution sequencing. 3. Your online account through the Social Security Administration shows your full benefit history at no cost. Use it. If someone you care about has a pension alongside their Social Security and has never run this formula, send this video to them directly. The information at number 4 could matter to their retirement for the next 20 years. The companion piece on Roth conversion strategy with the senior bonus deduction is the next video. See you there.